Radio.
Hello, everyone. Welcome to another episode of Cryptocurrent. Your host here, Richard Carthon. And today I got a very special guest, Daniel Simon. He's working on an incredible book talking about fintech, and he's going to basically share this information with us and all kinds of just deep knowledge and just so much stuff that I'm just ready to learn more about. Absolute pleasure to meet you. Thank you for joining us today.
Thanks for having me.
Of course. So before we get too heavy into this, how about you give us a little background about yourself?
Right. So I'm Daniel P. Simon. I'm the author of The Money Hackers, How a Group of Misfits Took on Wall Street and Changed Finance Forever. By profession, I'm a communications expert and speechwriter, and I've been on Wall Street for about 20 years, working with the heads of pretty much every bank out there. I'm speechwriter for people like Mary Shapiro, who's the former head of the SEC. I'm the speechwriter for Peter Grauer, the chairman of Bloomberg, who's also wrote the foreword for the book.
Wow.
And I've written speeches for the C-suite of pretty much every bank. As I said, I'm not really a finance guy. I never went to, I was never a trader or anything. I'm an English and French literature major who just happened to I could have done communications for anyone, and I did it in banking and in finance. I just found the world of finance to be fascinating. So with that in mind, I chair what's called the Communications Board at the Museum of American Finance. So that's formerly on Wall Street. We're the only museum of finance in the US. China, by the way, has 22 finance museums. We have one.
Wow.
So I chair the communications board at the Museum of American Finance. I run a PR and marketing firm called Vested, which is a global communications firm, and our clients like Morgan Stanley, BC Capital can see to Wall Street through the lead up to the financial crisis, and then after the financial crisis, and then this sort of nascent financial technology, as we used to call it, fintech, now technology, as it transformed the provision of finance, particularly in retail and commercial financial services. So, that's largely my background, and that is also explains kind of how the book came to be.
Yes, and thank you for that background. And I mean, the years that you've had in it, the speech writing that you've had, your knowledge in this space, and just access to everyone here, you've been with the brightest minds and have been able to truly just take in everything that's been going on. And you've basically seen from the beginning of where we were 20 years ago to now in the direction that we're headed towards the future, which I think is why, what you have to share in Money Hackers is going to be very, very important. So, what made you decide to write this book in the first place?
Well, like you said, I had this access to these people, a lot of the people, not all of them. Some of them I had to reach out to cold and say, hey, I'm writing a book. Do you want to appear in it? And some of those people have become, good friends since. People like Catherine Petrolia from Cabbage, or Rita Planche from Lending Club. But some of them, whether people like John Stein, who created Betterment, Adam Dell, who's Michael Dell's brother, and created Clarity Money and then sold that to Goldman Sachs. These are people that I knew anyway. Ken Lin from Credit Karma. And so, for a lot of it, it was just like, these are stories that I'd heard or, conversations that I'd had. And it was easy enough for me to kind of piece it all together. I genuinely also think that, someone needed to sit down and write the story of how this kind of came to be. I was, genuinely concerned that if someone didn't, we would miss a core part of our kind of financial history. Because very soon there's going to be a day where, we don't use cash and we don't go to an ATM and you may not go to a bank for something like a mortgage. And I felt like unless someone sat down and actually wrote that story, we probably wouldn't know how we got from something that had been unchanged for several hundred years to this completely brand new world that we were living in. And so this book is designed to kind of explain how we got here from 2008 to where we are today, what sort of mistakes the banks made, and what kind of opportunities this cohort of technologists discovered and took advantage of to create the fintech industry that we know today.
Yeah. And I mean, just on that note, one of the things you just said that spoke to me a lot, I was just listening basically how Rocket Mortgage has, it's a digital online platform that allows you to get your first mortgage. And a lot of people have been starting to go to services like that. So they're getting away from the traditional ways of how you even get money to buy your first house. And everything is definitely being more and more digitized. And, in the book, you talk about fintech transforming money itself. How has it done so? And can you share some examples from the book?
Sure. Yeah, I mean, I think one of the things that's really interesting, and by the way, Rocket Mortgage is an interesting example, because actually Rocket Mortgage is the baby company of Quicken Loans, which was a more traditional mortgage lender. And so, they learned the lesson with Rocket Mortgage that other banks had not, which was to sort of rebrand something, play into that fintech experience and build something. It's sort of like they were one of the first to do it. And if you look at something like Marcus by Goldman Sachs, that's actually what a lot of the more successful banks have done, is they've kind of set up these kind of skunkwork technology arms that are all digital or all mobile or whatever. I think one of the great ironies about how money is being transformed is about the payment experience, right? I think that the more ubiquitous the technology becomes, the less obvious the payment experience becomes. I mean, it wasn't that long ago that we all took Uber, right? And there's many things about ride hailing that I think that is fascinating. The fact that the rate, you could look at the rating system, you could look at the geolocation system that enables the taxi to know exactly where you are, and you can pre-negotiate a rate. All of this sort of stuff is fascinating. But I think one of the most understated or underwritten things about the Uber experience is the elimination, and I think people don't pay enough attention to that. I mean, living in New York, paying for a taxi was probably one of the most friction-filled experiences that you were going to have on a daily basis. It was almost always going to end up in a fight. Like, where are you going? Why do you care? Because I need to know whether I'm going in that way. No, that's not what the rule says, sir. You have to take me where I want to go. Okay, how are you going to pay? What business is it of yours if I pay? Are you going to pay me with cash? I don't have cash. I only have a card. Well, the company takes so much money out of my bill. That's not my problem. Like that, you'd have that conversation like 2 or 3 times in a day. Yeah. It just became sort of normal. So the idea that, the idea that actually all of that payment conversation is removed. You get in, you arrive at your destination, you get out. You never had to take out your wallet, your card, your phone. You didn't have to pay for anything. I think is one of the pieces of that experience that people don't realize is actually one of the best parts of the whole Uber experience. And the same thing is true when I order mine from Star. I really don't want to be standing around in lines. So I think one of the ways that money is transformed, or the payments are transformed, is that they're made invisible. In fact, that we don't actually have the transaction experience. I always say people love buying things, but they hate paying for them.
Yep.
The buying experience is like, gives you all kinds of endorphins and makes you feel great, makes you feel in control. The paying experience is just friction. It's just pain and misery. So I think one of the things that this technology has done is that it's made the payment experience invisible.
Yeah. And I mean, actually, that leads into another question I was going to have. You just talked about how frictionless everything is. And one of the first things that came to my mind as you were speaking through that is things have become more transactional in the sense of you're taking away the stress of the negotiation piece, right? Everything we were talking about, from the taxis having to get in to negotiate, price, where I'm going, why you should take me anyway, why this is even a conversation. That's just out the door. And now it's just like here's my service, let me pay, and let's keep moving. And, with everything that you just talked about, what do you think is the next big friction point in fintech?
Well, I would say a couple of things. I'm not sure I would agree on the point about transact. I think actually is that as the payment piece has become more invisible, as the transaction piece has kind of disappeared, the experience is actually a lot more about a relationship and about service. So it used to be that the bank's only job or a financial services provider's job was to move money around. Like that was their entire job. But as that has become essentially invisible, essentially it's become commoditized. The question is, what are you doing for me? And that idea about something that's transactional and a commodity versus something that's relational and an experience, I think is one of the big changes that's happened in financial services over the last 10 years. And you see that in every area of financial services, right? So if it's about savings, it used to be enough that you would charge me just for the saving, right? So things like security, like you keep it, literally, you think back to, It's a Wonderful Life, right? Why did you have a bank? It's because it was safer than keeping the money in a mattress.
Right.
So that was a very transactional experience, a very basic experience. Today, all of that is taken for granted. And so you see with savings apps like Stash and Digit, what they're offering is an experience and AI on top to help you maximize your saving or give you, or gamify your saving, give you, endorphin rush for saving. Can you add on top of a very transactional experience? If you look at robo-advisory, for example, that whole Wealthfront and Betterment, their proposition is that, it shouldn't cost you 100 basis points to invest. And so it's put enormous pressure on traditional financial services advisors, like wealth advisors, wealth managers, to kind of prove their value by offering additional services. So I would just say, actually the irony is that as the experience becomes more seamless, in order to justify their fees, financial services providers have to offer something experiential, something additional of value, and that's broadly very good.
Right.
I think that's a good trend, right? You shouldn't have to just spend a fortune. It shouldn't be very expensive and cost you a lot of money to invest in the stock market. It should be very easy and very cheap. And if you were paying more than the absolute minimum or free, if you were looking at something like Robinhood, or now, Charles Schwab, which just went to free trading, and E-Trade. If you're looking to pay any more than free, you have to be asking as a customer, well, what are you doing for me? You're giving me additional advice. You're giving me additional help. You're looking at me as a whole person. So that's the direction that financial services is moving, and it's a very good one. In terms of the friction points, I think some of the basic stuff, like how we split a pizza, has been solved. And I actually think that, there are some interesting areas that mostly relate to quite sociological things that are going on in our nation right now that I think fintech can be a part of. I was, for a very brief period of time, the fintech liaison for the Michael Bloomberg presidential campaign.
Okay.
And so I got to touch on some of the policy issues because I thought that fintech, really can help to bridge some of the biggest issues, right? So what's this current crisis exposing for us? Well, it's accentuating a wealth gap that was happening for 20, 30 years. It was accentuating a wage gap. We have income volatility that disproportionately impacts minority communities and lower income communities. And, fintech can help solve some of those problems, right? So real-time payments, so getting people paid in real time, fractional share ownership, so getting people access to, if wages effectively stagnate and assets increase, then we need people to have more access to assets.
Right.
So there isn't really a silver bullet solution except for just a more progressive policy approach at government to try and make sure that the world is a bit fairer, and that's about minimum wage policy, clamping down on the worst of shift work, taxing gig economy platforms properly, properly overseeing enormous monopolies like Amazon. But in the absence of progressive policies, fintech can at least help more people access, increasing asset increasing assets values more easily, get people paid more quickly, give people better access to credit. Because of course, poorer people use credit differently than wealthy people. People like me use credit to buy things that we can't bite off in one go, like a house or a pool. But your average person uses credit just to smooth over the peaks and troughs of the income volatility that their gig work or shift work job is forcing on them. And so, more responsible access to credit or real-time payments. That to me is the next real frontier. It's not about how you and I split a pizza or how the drone, gets the sushi into my mouth or whatever. I think like that,
right.
The basics, we were very far behind in this country in financial services, behind something like Europe. It was only a couple of years ago that you could really start to split a check with your friends or rent with your friends. Banking apps sucked in this country for a long time. We didn't have contactless payment in this country for a long time. If you 5 years ago, if you had gone to Europe and gone out for dinner, you thought you'd have gone to Mars or something. It's so far advanced,
right?
But for the most part, we're sort of we've sort of caught up to that. And so for me, it's not the luxury stuff that we need to now think about. It's the more fundamental socioeconomic things that I think fintech needs to get involved in.
I agree, and that's why I think when you think of, you talked about the wealth gap, you talked about opportunities and building assets and everything else. Fintech clearly is a way that a lot of those things can be addressed. It's just like you said, it's not a silver bullet. It's not going to just instantly fix everything. However, it's some of the first steps to actually address those issues. Instead of constantly talking about things, there are actionable things within fintech that we can apply, kind of like some of the examples you just said, that can quantify and give people opportunities to progress. And one of the things that in your book, it touches on the thinking behind fintech and, ideas like hedonic adaptation and democratization, and how it's having a dramatic effect on the entire banking and finance industry. Can you just dive into that just a little bit more? Sure.
I think that so it really goes back to 2008. So in 2008, I was in New York and I stood outside Lehman Brothers and I watched people leaving with their stuff in boxes. And so in 2008, for me, that meant the financial crisis, and it did for a lot of the people in New York. There were a lot of people, predominantly on the West Coast, for whom 2008 did not mean the financial crisis. Yes, there was this thing going on over there called the financial crisis, but 2008 will always be the year that, for example, the iPhone App Store is launched, or Facebook hit 100 million users, or Google and Amazon and these sort of web 1.0 pioneers start to really make an absolute fortune. And so the banks and the technologists learned two fundamentally different conclusions, drew two different conclusions at the same time. The banks decided innovation is dangerous. And the second thing they learned was that the mass market was dangerous. So they were innovating with things like credit derivatives, credit default swaps, these complex asset classes. They were also doing things with real algorithmic trading, electronic trading. And when the world went to hell in a handbasket, they decided innovation is dangerous. These technologists have taken us in a wrong direction. We should just stick to what we do really well. And P.S., the mass market is dangerous. We extended credit into these communities that couldn't afford it. People went and got 3 houses, and they, and now they're bankrupt, and we end up carrying the can. We've got all these defaults, right? So right. The banks decided in 2008, innovation dangerous, mass market dangerous. The technologists looked at a platform like Facebook, an ecosystem like Facebook, like Google, like Amazon. They looked at the growth of those platforms. They looked at a platform like the App Store. And what they saw was a rich opportunity for innovation. And they also saw the dreams of Web 1.0 coming true. That is to say, what they used to say on the West Coast, URL, ubiquity first, revenue later. So when the 90s, when the dot-com bubble was around and we were saying, it's going to transform the world and, there will be ubiquity first and revenue later. They weren't wrong. They were just, 10 years too early. But by 2008, this stuff is starting to come companies like Facebook, companies like Google, companies like Amazon are making absolute gobs of money. And so they drew the opposite conclusion. Now is the time to innovate, and there's money to be made in the mass market. There's a money to be made by going very broad. And so the banks were doing the opposite. They were going narrow and they were going up market to a smaller subset of technically more profitable and safer clients. And you know what fintech is about is it's largely been about provisioning financial services for the mass market. So making the cost of these services cheaper and enabling more people to get into it. So you think about something like a Wealthfront or a Betterment, just use investing, or a Robinhood with trading. You know, it used to be you needed $25,000, $50,000 to get into the stock market, and you also had to be comfortable spending a lot of money with a financial advisor to manage your money.
There's a big barrier to entry.
A huge barrier to entry. And most of these technologies, you know, if they're not free, they're incredibly cheap, and they're deliberately aimed at serving the mass market. Cabbage, you know, Cabbage was built, you know, as a lending company, and you think of it as a small business lending, but their definition of small business is very small. I mean, it's Amazon merchants, and they kind of built up around the Amazon ecosystem. So you know, it really is about making money at very large scale on very small numbers. And in the last few years, you've seen every bank has launched a robo-advisor. Morgan Stanley bought E-Trade. Goldman Sachs launched Marcus. And so they've clearly learned that lesson, that there's money to be made. This idea about democratization of finance. It's not just the right thing to do to extend, you know, the power of the financial industry to everyone. It is also a way to make money.
For sure.
And that's the win-win. That's the dream. If the banks can make money by making services better and cheaper and more self-explanatory for more people.
No doubt. And just going back to that reoccurring just issue over the years of barriers to entry and understanding, as you said, getting to that mass, and there's just so much more opportunity, because if you have 100 million people giving you $10 as opposed to having 1 million people giving you whatever, like those numbers can truly like work in your favor if you're doing it right. And they're also starting to see we are living in a world of access. We have technology. Like if there's anything that you want to know in the world right now, you can ask Google, you can ask whatever search engine that you have, you can get the information. Whereas before it was like, it was coveted. The information would be held close to the chest and you would need to pay for access to be able to do certain things, where now that's just not the case. And so, you know, another
touching on a point there about financial literacy, right? Yeah. Because like the way I always think about it is like the financial industry prior to 2008 was a bit like the Catholic Church before the Gutenberg Bible, right? Everything was in Latin. Mm-hmm. You could kind of go in, right? The banks looked like churches, very high ceilings. You could kind of go in. They spoke a language you didn't understand. You know, there was a ritual, you know, APR and, you know, hocus pocus and stuff that you couldn't really make any sense of, and you weren't supposed to because it wasn't for you.
You needed somebody to interpret it for you.
Yes, you know, there had to be someone to intermediate between you and God, or you and your money. And that was very much engineered complexity. It was engineered complexity on the part of Catholic Church in the 14th century, and it was engineered complexity on behalf of the financial industry in the 20th century. This stuff is way too complicated. You'll never be able to understand it, you know. And you know what? Compound interest is really not that hard to understand. It's pretty basic math, actually. Most of this stuff is pretty easy. I think one of the things that the tech did so well is, you know, the genius of someone like a Steve Jobs is that, you know, he wanted to make things beautiful, intuitive, and simple, right? And so, you know, before she passed away, my 94-year-old grandmother was like FaceTiming me. Now, she would never be able to have used a, you know, mid-80s computer. She wouldn't have been able to code anything, but, you know, the iPhone made it so she didn't have to.
Right.
You know, and so by now, you know, it's, and so that's something John Stein once said to me that I think is very powerful. He said, you know, financial literacy is bullshit. It's all just a matter of user design. Yeah. And he's right. Why is it? You don't need to know how electricity works to switch on the light, you know, and you don't have to know how to wire a computer to be able to use an iPhone. These guys, you know, in order to be able to get mass access, in order to be able to get the most number of people using it, they made it as simple as they possibly can. Why is finance even talking about financial literacy? We're the only industry that says you have to be smart enough to be able to use us, and it's kind of gross. And so, one of the things that I really love about some of the things in fintech is how simple and intuitive it's become, to the point actually that you don't even have to think about it, right? I mean,
right.
Amazon, I got a couple of things on subscription with Amazon, right? Amazon knows that I buy a certain brand of toothpaste, and they know the regularity with which I buy that toothpaste because they use a lot of processing power. And sometimes it's a little scary and creepy, but quite often they're like, do you want to save 20% by subscribing to this thing you've already proactively had to think about buying 50 times? And I'm like, yeah, why not? Well, something like Stash and Digit basically does the same thing with your money. They see when you've got 5 cents or 20 cents or $1.50 you're not going to care about based on what your spending patterns are, and they just take it and put it in your savings account. Right. I didn't have to learn about compound interest. I didn't have to go to school. I didn't have to become a better saver or a more responsible saver. I had to, download one app and link it to my account using Plaid. I mean, it really couldn't be, or Yodel, it couldn't be more simple.
Right.
And so we're finally getting to a place now in finance where we stop punishing the customer for not knowing enough about how to use our product. It's the only industry where you could get away with that shit. Every other industry, if you had any other industry, you sold a brand of car, but it was, the steering wheel turned the opposite way from every other steering wheel. The stick shift was in the roof, and you had to train your people to use it. No one would buy the car. You would go out of business, right? Like, it's that simple. Only finance can get away with saying, you're too stupid to use our products. And I'm glad to say that that's coming to an end. So when we talk about these ideas of democratization, access, inclusion, and education or literacy, that's part of it.
Right. And I think you brought up a ton of great points, and one of them that really just stuck out to me is just like you said, it's the interface that's changed. By making an easier, more intuitive interface for all these quote unquote complex or things that people wouldn't regularly understand, you could still ultimately achieve what you need. Hey, you say you're not good at saving money? Download this app. It's going to do it for you. Hey, you say you don't know how to start trading stocks and just putting a little bit away so you can start putting it into the market. Hey, just put this auto thing on here and it's going to do it for you. Like, the interface has changed in that access, and which is giving a lot more people access to opportunity. And going back just a little bit, you talked about.
And by the way, just one other point about inclusion.
Yeah.
When you make it an electronic interface instead of a human interface, you take away a lot of innate bias.
Yeah. Exactly.
And that unfortunately is another factor that's been inherent and systemic inside, and it's very timely right now. Systemic inside the financial services is a long history of redlining and a long history of perhaps unconscious bias, not necessarily overt racism, but in just unconscious bias, not just towards people of color, but women, for example, with regards to small business lending and other things like that. So, when you seed the information to the technology, you seed the decision making and the processing to the technology. Now, obviously, there's risks about how you write the algorithm, and you have to be very thoughtful about what you put into the computer because you only get out what you put in. But for the most part, certainly the technology, the interface being a computer, has responsibly extended credit, responsibly extended the ability for housing, responsibly extended the ability to get into the stock market without some of those unconscious or innate biases that maybe you might have found in your local bank manager from 30 years ago.
Right.
By the way, let me just one final point on that. If there was a bank in your neighborhood, because the other thing we have is banking deserts in this country. Again, not necessarily an overtly racist decision, but a ruthlessly corporate decision because of the cost of infrastructure to build a bank, put a branch, service a branch, versus what they're going to get out of a market. you've ended up with entire swathes of this country that are just woefully underserved by the traditional banking industry. You put that all on a cell phone, and it doesn't matter. You build the infrastructure in one place, and you put it on a cell phone. It doesn't matter if you've got a bank branch, and now your bank can be everywhere. So, inclusion is a key part of this democracy and access angle of fintech.
Right. And I think this leads right into what I think is what I'm calling right now the great equalizer, which is what came out of the 2008 financial crisis, which is cryptocurrency. So in your book, you address the rise of cryptocurrency, and you start with Charlie Schrimm's story. Can you tell us a little bit about Charlie and how he helped shape crypto today as we know it?
So this is the first thing to say about me. I'm not a crypto expert. I just play one on TV. Charlie, I think most people know the story of Charlie Schrimm. Charlie, created BitInstant, which was one of the first cryptocurrency exchanges. He did that with backing from the Winklevoss twins, who've gone on to obviously be enormous names, in the crypto space. Was busted for his involvement in the Silk Road. I mean, he wasn't specifically on the Silk Road, but he was making current cryptocurrency exchanges for people that he knew were in the Silk Road, and he ended up serving 4 years in prison in Pennsylvania. So he's a fascinating character, and he's become a close friend of mine. I was the first guy to interview him when he came out of prison. And then I interviewed him again for the book, and then he put me on his podcast. So in many ways, he was a poster child for the kind of the early Wild West nature of crypto, its opportunities, its sort of explosive opportunities, and its associated risks. Whether it's the sort of financial, his was legal, but it was almost like a metaphor for the kind of Wild West is the way to think about it. People getting insanely rich, people losing all their money overnight, all this volatility. Right. He had a very volatile life because of his involvement. So in many ways, he's the sort of perfect guy to, he's the perfect guy to sort of tell that story, or to tell that story through. Definitely. I think, what I would say about blockchain and crypto, you call it the great equalizer, because there is very much embedded within it this idea of decentralization, this idea of equalization, of taking the levers of power from out of the hands of the powerful. And, I think what's interesting to me, being a financial guy, is that the people who have most adopted crypto as well as the underlying blockchain and Ethereum technologies have been financial services companies. So, yeah. And in fact, it weren't for so it's sort of there's this tension between the sort of the anarchic vision of the people that got into it. But I will tell you, and this might disappoint some of your listeners, but the reality is it were not for the participation. In some cases, the full-throated participation of people like Blythe Masters, but also people like Barry Silbert from Digital Currency Group, taking institutional money and putting it into this. If it weren't for the fact JP Morgan created a crypto desk, this would not have got much beyond a kind of a weekend science project. You know what I mean? So what we have right now is a kind of an interesting marriage between the people who would seek to kind of, disintermediate and decentralize, and the very people that they're trying to disintermediate and decentralize.
Yeah, and when you look at who's using the underlying technology of cryptocurrency and blockchain, of cryptocurrency, it's blockchain, and you see a lot of banks actually starting to implement blockchain technology. And I think you actually address some of this in your book. What do you? And you kind of
that's why Blythe was the most unlikely face of blockchain. Having been the CFO at JP Morgan's investment bank, having been part of JP Morgan for 20 plus years, having created the credit default swap, will be part of the team that created the credit default swap. She is the poster child for everything Charlie isn't. She's the poster child for, institutional banks. And she's got a lot of love, and she's sat on all the right committees, and she's still a misfit by virtue of the fact that she's a woman. She was a pushy woman at a time when you didn't find many pushy women in finance. And from that regard, she's an outsider. Even as an insider, she's an outsider. I think that's, I talked to her a lot about this. I don't know I think that's why she was drawn to it. Because the interesting thing about blockchain and Ethereum is that they offer enormous efficiency gains. And so even as they also promise some sort of decentralization, they offer efficiency gains. And so the risk for the movement, if you think of it as a social movement, the risk is that, the original goals get perverted in the name of just the greater efficiency, help all these central or counterparties of these exchanges and banks and these people that were designed to be disintermediated. You're just helping them do their jobs. First, you're seeing this a little bit with the rise of central bank digital currency, right? So you see CBDC. Central banks do not want a decentralized cryptocurrency. They're not looking they're not looking for blockchain. For Bitcoin or a blockchain. Like they want the cryptography. They want the ease. They want they want the technology. And they don't want the idea. They don't want to lose control.
They don't want the decentralization side of it, but they want the centralized version of all the good stuff that cryptocurrency has to offer. And when you even like just feeding on that question is like, when you think about Facebook and what they did with Libra, like, do you think it's inevitable that other big tech's going to continue to enter this space to try to kind of do the same thing that they're trying to implement?
I don't know. I mean, so COVID has thrown everything for a loop. I always say that, what's the one thing that like Donald Trump and Maxine Waters can agree on? And it's like, they don't like Facebook, right? So, I think that if you look at the start of this year, we went in and there was a bunch of cryptocurrency regulation in front of Congress. And like I said, I'm not a crypto expert. I don't follow it every single day. But I think one of the reasons that there was this raft of cryptocurrency regulation in front of Congress this year was because of Libra and because, they were just sort of caught flat-footed and they thought, well, Christ, we don't even have a way to regulate this. We don't have a way to define, cryptocurrencies versus crypto commodities versus crypto assets. And now, Facebook is sitting here in front of us with a proposal for a global currency that they like, oh my God. So I think it's been a wake-up call. And it's also a wake-up call for a lot of, ECBs talking about, CBDC, a lot of other, financial institutions, governments, the established institutional framework. If you think about, the post-war consensus, the Bretton Woods, the United Nations, the World Bank, the World Health Organization, down to the banking systems, the SWIFT payments rails, like Cybos, like there is a giant infrastructure in place that this threatens. And I think, when Facebook came out, it shook a lot of people out of their stupor about the potential. Now, how they respond to it, how quickly they respond to it, what they do, what their response is, whether it's to try and do stuff for themselves or to regulate what's in front of them will vary from place to place. And like I said, coronavirus has kind of put all of this, on the back burner for now. But it is obviously going to be a fascinating space to watch. I mentioned earlier in this conversation that, the internet wasn't wrong. It was just too early. And I think, the blockchain and Ethereum, we talked to Vitalik in the book. And I think, Ethereum's and smart contracts and, the stuff that Michael Casey gets out of bed in the morning for, I think has enormous potential. I just think it's like the internet. It's like we're in like 1998. Like, you could probably parallel it. When did like Tim Berners-Lee come up with the internet? It was probably like 1988. By 1998, we had like enormous hype. So that's like 2008, Satoshi Nakamoto white paper comes out. Like, we've had this hype.
Right.
There's something called the Gartner hype cycle. I don't know if you've ever seen it, but it has the sort of the peak of inflated expectations followed by the trough of despondency. Mm-hmm. And then you have this long period of kind of making it work. And I think that was the internet, right? I mean, pets.com, we had some famous explosions, AOL, lots of stuff went wrong. But the promise of the internet, right, which was like, this is going to fundamentally revolutionize commerce and the way that businesses operate, it's real. Peacock's launching this month. We've got a 5th streaming service. We've totally transformed content in the way that, AOL Time Warner got up 22 years ago and said would happen. They just said it was going to happen in 5 years, and it took 22.
Right.
I think that when we look at blockchain and DLT, that's we're going to be looking at the same kind of timeline. It's going to take 20 years.
Yeah, and it's a time is of the essence in the sense of what I think would have taken 10 to 15 years of where crypto and blockchain was headed. COVID sped up the process because now there's a lot more attention on the space. There's a lot more money starting to flow into it. There's a lot more people trying to figure out how can we implement this sooner, because they're starting to see the opportunity in just all the different ways that this can revolutionize visions that they have in place for the future. And one of the things that I kind of wanted to wrap up with, because man, you have absolutely gave us a ton to think about, especially in the fintech space, and just so much to unpack. And I think this is a great reason why people need to go pick up your book, because there's just so much that you just go deep into in this space. What is a final thought that you want to leave with all of our listeners here today?
I would leave you with the thought about the non-triviality of fintech. So that is the point I made about the socioeconomic stuff. I think This crisis, particularly for certain communities of color, minority communities, immigrant communities. I'm an immigrant myself. I think it's a double crisis, right? There's a health crisis and there's a wealth crisis,
right?
And one is layered onto the other, right? So poorer communities are frontline workers; they're more likely to get exposed to this horrific virus, but they're also, no one came out and said our essential workers need to earn $25 an hour, right? Yeah. No one said that in this country, which is incredible. Right? We said, thank you for your service. And we clapped and we banged pots and pans. And then we continued to treat these people like shit. And they are the only reason that we have anything right now and that we're not in total anarchy. And if minimum wage in New York had kept up with the price of rent in New York, which is a relatively progressive place, it would be $22 an hour. So, we have an eviscerated middle class, and we have a financial crisis. Before the crisis, 50% of Americans didn't have $500 in emergency savings. So half of the country could not absorb a shock of more than $500. And you imagine what that is like today. We are about to face a tidal wave of evictions as government stimulus runs out, and as some people in the government feel that we've been already too generous with welfare and unemployment. So we have some major policy issues in this country. I think that we can't solve them all without real government intervention. And Congress needs to step up and do its job and look after its people that sent them. However, one of the reasons that I was very excited about the very short-lived Michael Bloomberg campaign, and I was very happy to be involved as FinTech liaison, is because I think that there's a lot that FinTech can offer that is non-partisan, that both Republicans and Democrats can get behind. Things like real-time payment, the idea that people should get paid for a day's work. Because if you're going to make them do shift work and you're going to make them work in all kinds of odd hours, and you're going to say, actually, you don't need to come in for the next 4 days, and therefore shove enormous income volatility onto them, the least you can do is pay them for the work that they did. Right. If we are going to live in a world of gig economy and shift work, where essentially an underclass of people, service a smaller fraction of wealthy people, those people are going to need access to credit in a different way from the way that wealthy people need credit. And right now there isn't good credit options for people, or not very good credit options for people. A significant proportion of our population, about 20%, are still unbanked or underbanked. They're not even served in the traditional financial services industry. They operate in the cash economy. More Americans own a cell phone than own a bank account. So, we have to tackle the problem of the unbanked and the underbanked. So I think that, what I would just say is there's a lot of fun stuff in this book. The first story that we talk about is Venmo. When we think Venmo, you immediately think about splitting a pizza with your friends. There's a lot about fintech that is about making your, reader, the reader's life easier if they're a relatively, affluent white collar worker in an urban environment. But, at its heart, fintech is about making the power of the financial services industry, and finance is a very powerful technology that can enrich many, many people, making it more accessible, giving it to more people, extending it more fairly and without bias. And that's really what fintech for me is about. That's what I get passionate about. And I think that's my last thought. There's still a lot more to do in some areas that touch on some stuff that we're talking about in the news today, like, evictions, like wealth, like income inequality, and like race.
And I think that is an absolute great way to wrap up this episode, because there is so much just between inequalities and all the various ways that they are taking form. And then what are the ways that we can actionably start to address them and do something about it? And fintech is definitely a first step. And I think you do a solid job of being able to dive into this book and describe, one, how we got here, how we can do better, and start to address some of these bigger issues. So again, I really do appreciate you spending some time with us. What are some different ways that people can connect with you? And then also, how can we get this book?
Sure. So you can find me at danielpsimon.com or on Twitter at danielpsimon. And if you type The Money Hackers into any bookstore, Amazon or Barnes & Noble, this will come up and you can order it and it'll be there the next day. Or in some places, you can still walk into a Barnes & Noble and you should be able to pick up a copy.
Awesome. Well, I really do appreciate your time today, Daniel. And for everyone listening, stay cryptocurrent. Hi, everyone. Thanks for listening to another episode of Cryptocurrent. For more information on this episode and all of our episodes, please visit us at www.crypto-current.co. Stay up to date with the latest news in cryptocurrency. You'll receive daily emails Monday through Friday that are personalized and curated content specific to you and your interest, powered by artificial intelligence. Are you an accredited investor looking to invest in cryptocurrency? Crescent City Capital can help. Go to crescentcitycapital.com for more information. If you're finding value in our content, please take 5 minutes to leave a 5-star review and a great comment. Also, please make sure to share this podcast with others. Hello, everyone. I hope you're enjoying the quality of this podcast. I can only thank my amazing producer, Andrew DeRitter, with DeRitter Productions, who has put this together. If you have any podcast, visual, or video needs, please go to DeRitterProductions.com. That's DERITTER Productions.com.
Thanks for tuning in to another episode of Cryptocurrent with Richard Carthon. We'll be back with more exciting developments from the world of blockchain and cryptocurrency next week. But until then, stay cryptocurrent.
Please use available exits now.